any change to your asset allocation at a 3% 10-year?
No, there really isn't. I think that we'd like to sort of look at round numbers and paint ourselves in a quarter and think this is going to be some sort of an event where it's not. We'd be much more concerned about the shape of the curve than we are about the 3%. We think we're going to be in a 2 3/4, 3 1/4 range for the balance of this year, and probably exit the year at the higher end of that range. But I don't think that's at all a detriment to equity investing. I do think, though, that if we see any more tightening in the 2s and the 10s or the 5s and the 30s, that becomes a concern, because the flatter that yield curve gets, the less willing banks will be to lend money. So that could be the economic slowdown. I certainly don't think 3% is going to be a benchmark we talk about much longer now that we've gotten here and can put it behind us.
And Art, is the answer to that question basically up to the Fed? That is to say, are they going to back off on some of the rate hikes given what's going on in the economy?
Well, I will tell you this. The Fed's been pretty straightforward and stuck to their narrative that they want to normalize rates. What the Fed controls is the front end of the curve, though, and I think what's really happening at the belly of the curve, at the 10-year, is that the new issuance has been focused on the front end of the curve, right? So even this week, when we look at the auctions that we have, everything's focused on the front end. I think it may well be the Treasury Department that wakes up and looks at the flattening yield curve and says we need to issue more at the belly and the longer end of the curve to actually help broaden that out. So if we were actually to see more issuance from the Treasury in the 5s, the 7s, and the 10s, you'd certainly see a steepening of the yield curve. Right now, the focus has been on the front end of the curve. So I think part of the problem is the concentration of the new issuance, and there's going to be plenty this year at the front end of the curve, and that's probably where you see the change. But I certainly think we've heard from the Fed over the last week or so that they're paying close attention to the flatness of the curve, and that may well slow them down. But right now, the message is pretty clear. They want to go 3 times this year. You
would have thought that the 29 basis points in the 530 would have maybe tipped the scales for issuance, but it did not indeed. The question, though, my favorite question, is what it winds up meaning for gold. So come inside the Bloomberg, and this is what really matters for the gold market. So you have the yellow line is gold and the blue line is 10-year real yields. They have been moving higher, though off the highs. They were at about 80 basis points. Jim, give me your call.
Well, we're looking for moderately higher prices from here in the longer term. But right now, there's no doubt that higher rates are the enemy of gold. The reason why we don't think it will provoke a significant decline this time, if you look at it historically, when the Fed raises rates 3 or 4 times in a year, the gold market usually goes down as much as 10%, but that's when gold prices were significantly lower. I don't know anybody that hasn't been expecting this, that doesn't expect that rates have gone up. And I think if you look at the way gold reacted a few years ago when quantitative easing began to end and we got that significant decline, a lot of this is already cooked into the gold price. So we don't see it as weakening gold so much as presenting headwinds.